Behind the scenes of the markets, a storm is building. Hedge funds, the biggest players on Wall Street, have been piling into interest rate derivatives for years. These are complex financial bets that depend on stable bond markets. But bonds aren't stable right now. Interest rates have been swinging wildly, and those swings are ripping holes in hedge fund balance sheets. Many of these funds are leveraged, using borrowed money to amplify returns. When bond prices move too far, too fast, they start to bleed fast. And now the Federal Reserve is watching closely, because if one of these funds blows up, it could set off a chain reaction across banks, lenders, and the entire credit system. So what happens next? The Fed won't call it a bailout, not after 2008, not after public outrage. But make no mistake, they'll act. They'll open up liquidity windows, they'll activate swap lines, they'll provide stability to important institutions, and it's already starting. The repo market, short-term lending between financial institutions, has collapsed to all-time lows. That means banks don't want to lend to each other. Why? Because they don't trust what's on each other's books. That's a major red flag. On top of all this, tariffs are starting to pressure the global supply chain. Trump's proposed 245% tariffs on Chinese goods are sending cost shocks across global markets. That makes inflation worse, debt harder to manage, and adds pressure to central banks to intervene. And they are intervening. Globally, we're seeing record M2 growth. China, Europe, Germany, the UK, all printing money, all cutting rates. The Fed may say everything's fine, but their actions suggest otherwise. They're preparing to quietly backstop the most fragile parts of the system, including the hedge funds that helped create the risk in the first place. Thanks for watching Dealmakers Den. Like, subscribe, and we'll see you in the next video.